In late December 2025, Meta announced it had agreed to acquire Manus, a Singapore-based Chinese-founded AI agent startup that had, according to Manus, crossed $100 million in ARR 8 months after launch. According to Manus, processed more than 147 trillion tokens and raised a $75 million benchmark-led round at roughly a $500 million valuation. The deal, which Bloomberg reported was struck in roughly 10 days, was valued at approximately $2 billion, with some outlets citing figures closer to $2.5 billion. Manus's own website updated to reflect the acquisition. According to people familiar with the matter, Manus staff had already moved into Meta's Singapore offices. Investors including Tencent, Zhen Fund, and Hongshan had reportedly received proceeds. Then, on April 27, 2026, China's National Development and Reform Commission issued a single-sentence order to prohibit foreign investment in Manus and require the parties involved to withdraw the acquisition transaction. No detailed legal rationale. The public order gave no detailed legal rationale, although Chinese authorities had reportedly been reviewing the deal for months. One sentence and a multi-billion-dollar deal that had already closed was formally ordered to be unwound. What makes this case significant is not the dollar figure, and it's not the geopolitical friction, which had been anticipated by some observers. What makes it significant is the sequence. It did not merely block a pending acquisition. It ordered the reversal of one that had already closed. That distinction between a pre-close veto and a post-close reversal is what legal analysts at O'Melveny and Morgan Lewis described as the first publicly confirmed unwind of a consummated AI transaction under China's Foreign Investment Security Review framework. The question this raises is not simply about one deal or one company. It's about the rules that govern cross-border AI transactions going forward, and whether a playbook used by a growing number of Chinese-origin startups to access Western capital and markets still functions the way they assumed it did. To understand why Beijing intervened, you first need to understand what Manus actually was, because it was not what most people assumed when they heard the word AI company. Manus did not build a foundational model. Manus's stated approach was not to train a proprietary LLM from scratch. Rather than competing primarily at the foundation model infrastructure layer, Manus positioned itself as an agent layer built on top of frontier models. What its team built was an agent framework, a coordination system designed to sit on top of existing frontier models and execute complex, multi-step tasks autonomously. Manus was marketed as a general-purpose agent for research, coding, data analysis, and browser-based tasks, using an agent loop to plan and execute multi-step workflows, with frontier LLMs as the underlying reasoning layer. Jia Chao, the company's chief scientist, articulated this design philosophy explicitly in a technical essay published in July 2025. If model progress is the rising tide, we want Manus to be the boat, not the pillar stuck to the seabed. The implication was deliberate. Rather than betting on a single proprietary model, Manus was architected to benefit from the entire industry's progress. The company launched in March 2025 and scaled with unusual speed. By December, Manus said it had crossed $100 million in ARR, a threshold it claimed to have reached in approximately 8 months, alongside a claimed total revenue run rate of over $125 million. According to Manus, more than 147 trillion tokens processed, and according to Manus, more than 80 million virtual computers created across its platform. It did this with 105 employees distributed across Singapore, Tokyo, and San Francisco, which works out to roughly $952,000 of ARR per person. That operational profile, relatively lean by headcount, with reported revenue traction and no need to train a foundation model from scratch, was precisely what made Manus attractive to acquirers. But there is a second layer to the story, one that becomes relevant when Beijing's logic is examined. In July 2025, Manus began shutting down its China operations, reportedly laying off employees who did not relocate and shifting its operational center to Singapore. The reason, according to reporting by the Washington Post, was practical rather than purely political. CEO Xiao Hong told employees that Singapore would give the company easier access to advanced U.S. origin language models that were unavailable or restricted in China, and that international clients, particularly those willing to pay premium prices, were more accessible from a Singapore base. Reporting suggests that redomiciling had business motivations, access to U.S. origin models, and higher-paying international customers, as well as regulatory implications. What neither Manus nor its advisors appear to have fully accounted for is that Beijing would draw a different conclusion from the same set of facts. Less about formal incorporation alone than about the Chinese origins of its technology, talent, and operations. It on is to Meta's 2026 capex plan and cash position. The Manus acquisition was not a large bet. In the first quarter of 2026, Meta reported $56.31 billion in quarterly revenue, $26.77 billion in net income, including a one-time $8.03 billion tax benefit and $81.18 billion in cash and marketable securities. Its projected capital expenditure for the full year was $125 billion to $145 billion, a figure that, on the April 29th calls, Zuckerberg framed around the company's goal of delivering personal superintelligence to billions of people, while CFO Susan Li tied the infrastructure spend to training and inference capacity for agents at global scale. Against the midpoint of that capex range, a $2 billion acquisition represents approximately 1.48% of a single year's planned capital expenditures, a capex plan largely driven by AI infrastructure. For context, Meta's earlier investment in Scale AI was reported at $14.3 billion, between 5.7 and 7.2 times larger than the Manus price range, depending on which valuation figure is used. The publicly stated strategic logic centered on integrating Manus's agent capabilities into Meta AI and Meta's consumer and business products. Manus offered a working, revenue-generating general-purpose agent product that Meta said it planned to scale and integrate into Meta AI, amid intensifying competition with Google, OpenAI, and others to build AI agents. The deal was agreed in approximately 10 days, a compressed timeline for a multi-billion-dollar cross-border technology transaction. The speed of the agreement left less visible time for extended regulatory pre-screening. By the time the acquisition was publicly announced on December 29, 2025, some post-close integration steps were already underway. Manus's website had been updated to reflect its status as part of Meta. According to Bloomberg reporting carried by the Business Times, Manus staffers had already moved into Meta offices in Singapore, and Bloomberg and the Wall Street Journal reported that investors, including Tencent, Gen Fund, and Hongshan, had already received proceeds. Xiaohong, Manus's CEO, issued a statement that captured the mood of the moment. Joining Meta allows us to build on a stronger, more sustainable foundation without changing how Manus works or how decisions are made. What that statement did not account for, and what Meta's post-announcement assurances about Chinese ownership and China operations did not resolve, was the position of a third party whose approval had not been publicly disclosed, and had not publicly accepted the Singapore incorporated structure as removing the deal from Chinese security review concerns. Meta told the press, prior to the ban, that the completed transaction would carry no continuing Chinese ownership interests in Manus, and that Manus would discontinue its operations in China. Those assurances did not prevent Chinese regulators from ordering the transaction withdrawn. China's Ministry of Commerce confirmed it was reviewing the acquisition on January 8, 2026, about 10 days after the deal was announced. Bet timing alone was notable. The review was not triggered after a prolonged observation period, but within the first fortnight of public disclosure, which suggested Beijing was treating the transaction as strategically sensitive from the outset. A series of state actions followed over the next 3 months. The most visible came on March 25, 2026, when it was reported that Manus Hong and chief scientist Ji Yichao had been barred from leaving China while the review was ongoing. The use of exit restrictions, an unusually coercive tool in the context of a corporate M&A review, suggested Beijing was treating the matter as more than a routine regulatory review. It was treating it as a matter of state interest, in which the founders themselves became direct points of leverage in the review. Then, on April 24th, Bloomberg reported that Chinese government agencies had instructed a number of major private technology firms to decline U.S. origin capital investments unless they received explicit official approval. A directive that, if accurate, placed the Manus case inside a broader policy posture rather than framing it as an isolated, bilateral dispute. 3 days later, on April 27th, China's National Development and Reform Commission issued its formal order. The language, as rendered in English language coverage, was direct. China would prohibit foreign investment in Manus and require the parties involved to withdraw the acquisition transaction. No detailed legal rationale was published. The published order did not provide an extended legal argument. Analysts noted it consisted of a single sentence without explanation. Legal analysts who reviewed the order noted two details that carry structural importance. First, Melvini described the practical challenge facing both parties as having to unscramble the eggs, a phrase that captures the operational reality that this was not merely a pre-close veto, but an order to unwind a deal that had already closed. Second, and more consequentially, Melvini noted that the NDRC order referred to the Manus project rather than a particular legal entity, a drafting choice that, according to analysts at both O'Melveny and Morgan Lewis, indicated regulators were looking straight through the Singapore holding structure to the Chinese origin of the underlying technology team and intellectual property. That distinction matters enormously. The outcome suggests that redomiciling to Singapore, removing Chinese ownership interests, and ending China operations were not sufficient to satisfy Beijing. The review appears to have looked beyond legal form to the provenance of the technology, team, and IP. Meta's response was brief. The transaction complied fully with applicable law. We anticipate an appropriate resolution to the inquiry. The public resolution was an NDRC order requiring the transaction to be withdrawn. The central question raised by the NDRC order is not only whether Beijing asserted authority under China's foreign investment security review frameworks, but rather what standard it applied when deciding that Manus was subject to that authority in the first place. Manus did not build its own foundational model. Public reporting has not identified Manus as a foundation model lab built around proprietary training data at unusual scale. What it had was a team of engineers who had built an agent system on top of LLMs designed to perform multi-step tasks such as coding, research, and business analysis, that autonomously carrying out sophisticated tasks without human intervention. The decision suggests Beijing viewed Manus's AI talent and capabilities as strategically sensitive despite its Singapore incorporation. Morgan Lewis's analysis of the case can be summarized as origin over domicile. The case suggests that restructuring, redomiciling, and removing Chinese ownership may not be enough if the underlying technology and team are viewed as China origin assets. He Yadong, a spokesperson for China's Ministry of Commerce, made the doctrine explicit during the review period, stating that enterprises engaged in overseas investment, technology export, data transfer, and cross-border acquisitions must comply with Chinese laws and regulations, a formulation that did not publicly exempt companies that had moved headquarters offshore. The Manus case was also not an isolated application of this logic. The Washington Post reported that MiroMind, another Chinese origin AI firm, had come under pressure not to relocate valuable talent and research capabilities out of the country. Bloomberg reported that regulators had instructed some Chinese tech companies to decline U.S. origin capital without explicit approval. The pattern across these cases is consistent. Beijing is not simply reacting to individual transactions it finds problematic. It appears to be using administrative interventions to signal that China origin AI capabilities may remain subject to state oversight even after a company changes its corporate geography. Analysts said the case may make Chinese security review a standard closing risk or condition in cross-border deals involving China origin AI assets. This is likely to change how deals involving China origin assets, teams, or code histories are structured, with longer timelines, more conditional terms, and no assumption that a completed deal is a secured one. The symmetry with U.S. policy is worth noting. Washington has used export controls on advanced semiconductors, restricted outbound investment in Chinese AI and chip development, and deployed CFIUS reviews, including post-closing unwinds, against Chinese-linked acquisitions of U.S. technology assets. Beijing has deployed a roughly analogous national security tool in the opposite direction, treating the NDRC order not only as a block on inbound foreign investment, but as a potential outbound transfer of China origin AI capability, despite the Singapore legal structure around the entity. The conclusion that follows is straightforward. AI is increasingly treated by both governments as a national security technology rather than a purely commercial sector. The capital markets' reaction to the NDRC order offers a useful corrective to the narrative that framed the Manus unwind as a catastrophic event for Meta. On April 27th, the day of the formal prohibition, Meta's stock closed at $678.62. The following day, April 28th, it closed at $671.34, a decline of approximately 1.07%. That price action suggests investors did not treat the NDRC order as a company-level crisis for Meta. It is the price action of a company for which a $2 billion acquisition, while strategically meaningful, represents a small percentage of Meta's 2026 capital program. The more significant market event came 2 days later. On April 30th, following Meta's Q1 2026 earnings release and the accompanying guidance that capital expenditure for the full year would reach $125 billion to $145 billion, the stock closed at $611.91, a single-session decline of approximately 8.55%. The sell-off was widely attributed more to Meta's higher capex guidance than to the Manus order. It was widely interpreted as a response to the scale of Meta's capex and AI infrastructure commitment. And the investor question that commitment raises: at what point and through what products and revenue streams does the midpoint of Meta's $125 billion to $145 billion 2026 capex plan generate a return? That distinction clarifies who the actual losers and winners of this episode are, when assessed with some precision. Beijing achieved its immediate objective, forcing the transaction to be withdrawn, suggesting that China's review framework can reach China-origin AI assets even after offshore relocation and compel the reversal of a transaction that had already closed, been publicly announced, and begun integration steps. Domestic Chinese capital could benefit if China-origin AI startups are discouraged from seeking U.S. origin funding, as reported policy signals also appear to discourage China-origin AI startups from taking U.S. origin capital without approval, potentially redirecting some future capital formation onshore. On the other side of the ledger, Meta absorbed a public strategic setback and lost access to a specific agent product it had planned to integrate into its AI roadmap. Manus's co-founders also faced exit restrictions while the review was underway. Global investors in cross-border technology deals now face a more concrete post-close intervention risk in China-linked AI deals. The idea that Singapore could fully insulate Chinese-origin AI companies from Beijing's reach took a credibility hit. A Singapore-based advisor, quoted by The Washington Post, summarized the outcome with an economy of language that required no elaboration. Manus is a lesson learned. The episode does not appear, based on available evidence, to fundamentally disrupt Meta's broader AI program. Meta remains among the companies planning the largest AI infrastructure expenditures, with $81.18 billion in cash equivalents, and marketable securities, 3.56 billion daily active people across its family of apps, and a capex plan that dwarfs the Manus transaction. The loss of Manus deprived Meta of a specific agent capability it had planned to integrate. There is not yet evidence that it has altered the broader trajectory of AI competition, which remains heavily shaped by infrastructure scale and model capability, not only by individual M&A outcomes. Jia Chao wrote in the summer of 2025 that Manus wanted to be the boat riding the rising tide, not the pillar fixed to the seabed. As a product philosophy, the logic was clear. Manus wanted to benefit from progress across frontier models. What the later NDRC order exposed was a separate risk: the jurisdictional control of China-origin AI assets. A former Manus engineer, speaking to The Washington Post, described Beijing's reaction to the company's departure from China as a slap in the face, a phrase that, while colloquial, captures something precise about the state's calculus. Beijing did not appear to read the move to Singapore as a purely neutral business decision. Chinese authorities appeared to view the deal as moving China-origin AI talent and capability into the orbit of a U.S. technology company. In that reading, the NDRC order functioned not only as a legal ruling, but also as a political correction. What the Manus case establishes, alongside reported parallel pressures on MirrorMind and other Chinese AI firms, is that two competing national security frameworks around AI are increasingly being enforced simultaneously, and that they operate with an increasingly narrow overlap. Washington restricts the export of advanced semiconductors, scrutinizes inbound Chinese investment through CFIUS, and limits outbound capital flows to Chinese AI and chip development. Beijing is using administrative pressure and security review to restrict the overseas movement of China-origin AI talent, know-how and systems, even when that capability sits in a Singapore-based corporate structure. The combined effect appears to be a gradual narrowing of the space for cross-border AI activity between the US and China, not through a single dramatic rupture, but through the steady accumulation of administrative decisions, many of which narrow the space for cross-border capital, technology, or talent movement. The question that remains, and which the Manus case does not resolve, is where that process ends. If origin increasingly shapes jurisdiction, if regulators weigh the provenance of the technology more heavily than the company's formal domicile, then cross-border AI development involving China-origin talent or assets may become more difficult to sustain. Engineers, data, training runs, and agent frameworks may increasingly carry provenance questions that regulators can treat as relevant. Whether that constraint ultimately reshapes how frontier AI is built, where it is built, and by whom, is the larger question that the NDRC's single-sentence order issued on April 27, 2026, placed on the table.